is Ryan Miller, and for the past 15 years, I've helped hundreds of people to raise millions of dollars for their funds and for their startups. If you're serious about raising money, launching your business, or taking your life to the next level, this show will give you the answers so that you too can enjoy your pursuit of making billions. Let's get into it. Can we just admit that pitching institutional investors is literally one of the most challenging things when raising money? So in this week's episode, I have my dear friend John Jennings talk about what he likes to see when getting pitched at his $15 billion investment firm. I can promise you it's not what you think. Stay tuned for all of this and more coming right now. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, John Jennings. John is the president and chief strategist of a $15 billion family office group known as the St. Louis Family Trust. He manages assets and allocations of 60 high net worth families, and he's an adjunct professor at Washington University, a Forbes contributor, and the author of the Amazon #1 bestseller, The Uncertainty Solution. So what this means is that John understands institutional capital and family offices, and he's agreed to come on the show to give you his advice on raising capital and asset allocation in the sector. So John, welcome to the show, man.
Great. Thank you. I'm super excited to be on. I mean, it's like people call on the radio shows, like long time listener, first time caller. So long time listener, first time on the show. And I also understand, and it makes me feel good, is that your listeners are not only just, way above average in intelligence and success, but they're all extremely attractive. So glad to put myself in that pool. Yeah.
Yeah. Well, we're certainly an honor to have you. And, the show is done very well and you're very generous, and it's all because of amazing guests like you. So, really quick, just in like 30, 60 seconds, tell us a little bit about what you do. How did you get there? And just warm us up a little bit.
Yeah. So I started as a estate planning and tax lawyer, and I also did a little bit of traffic law, still do. It worked at Arthur Andersen, doing investments and high-end tax planning strategy, tax shelters. It was a bunch of fun. And then you may remember that Enron thing, right? So Andersen, and it's really affected my worldview, is, we had 90,000 employees worldwide. And in the span of 9 months, went out of business. And we formed our current company, St. Louis Trust and Family Office, out of the ashes of Arthur Andersen. And, at the time I was like, oh, this is horrible. But it's selfishly turned out pretty good. And our secret sauce is we have 60 client families all across the U.S. Actually, most of them aren't in St. Louis, or a lot of them never been to St. Louis. But we have 64 employees. So we're, have this 1-to-1 employee to client ratio. And so it allows us to be incredibly customized because, our clients are mainly in the 100 million and up space. So they have a lot of complexity, need a lot of service, have a lot of opportunities, but a lot of, challenges as well. So yeah, that's what we do. And I'm president. I've been there, like I said, since day one. It's been fun.
Awesome. Well, thank you for that. So we go from practicing some law and all these things and finding your way, rising like a phoenix out of the ashes of Arthur Andersen to save ultra high net worth people, and that really helped to drill down. Now at 15 billion, and that's in the aggregate of all the stuff of the families that you support. Yeah. I would say you're right at that institutional level. I mean, that's just my opinion, but your perspective on this is not a small family office, folks. This is a large institutional investor and asset allocator and manager. Now, with all of that experience, we'll get into that big, sexy stuff in the billions of dollars. But before we do, we got people in 100 countries listening around the world as young as high school. Apparently there's a high school in Texas that literally learns finance from this show. So yeah, we got to love the kids out there, and all the way to other family offices and people like yourself and everything in between. So that being said, there are people listening. So let's address the beginners before we get on to the more advanced stuff. So that being said, John, I'm just curious, for the beginners out there, how do they win in the early days in asset allocation, in really just getting started in high finance so that they can get to that level? What would you say?
Yeah. So, I had this big watershed event that many of us had if they were, out working doing this in the financial crisis. And I'll tell you, up until the financial crisis, I thought to be, a good financial advisor or investment expert, like I had to know everything. Like I just drank from the fire hose of information. I read obviously the Wall Street Journal and every day, and Barron's and Investors Business Daily and Financial Times. I subscribed to all of these services, and, I read what all of our investment managers did. And I was like this walking, talking encyclopedia know-it-all of what was going on in the financial world. But, something funny happened is I didn't see the financial crisis coming. And then once we were in it, I couldn't see a way out. right? And I tell this story in my book, but I have this coworker. She's super bright, CPA, went to Tulane. She's fantastic. One of the co-founders of my firm. But like I went to this client meeting with her and she was so calm. It was like March of 2009, right? And she was like so calm. And I knew so much more than her about the market, but like she gave such better advice. And I was like, okay, something has to change. So really what I did is after the financial crisis is I turned off a lot of the news, a lot of the noise, trying to stay up with everything. And I shifted to seeking wisdom by reading more and more books, and I read a ton of investment books, but also other areas, physics and statistics and psychology, works of fiction, and a lot of biographies. And it's interesting, Charlie Munger, who recently passed, but, one of the wisest men, around, said you'll learn more by reading books than reading research reports and, 10Ks and everything. And he said, you learn more by reading 100 biographies than 100 investment books. And I really think it really differentiates people to go read books, because you'll have somebody that, spent, I don't know, decades of experience, and then they'll write and tell you basically what they learned, and you can read it all in like 4, 5, 6 hours. It's amazing. And so, yeah, that's my biggest piece of advice of people of all ages. You got to be a reader and read books. When people are like, oh, I read, I'm always reading, but I'm reading, like news reports and white papers. I'm like, yeah, not the same. Not the same.
And that's I would say, listening to you on that, that's a difference between absorbing knowledge and absorbing wisdom that you first alluded to, is to say, do you know the most? Well, did this person know the most in your opinion? Probably not, but they had a way about them that communicated information in a wise way.
Like I read 66 books last year. I read 69 the year before. 2019, I read 101 books because my goal was 100. And one thing about having a goal of reading a lot of books, and I think at least a book a month, but you can do 2 or 3, 4 a month. I think without a whole lot of trouble, is it keeps you from doing other things that are going to distract you and probably waste your time. Like if you're spending any time on TikTok or X or Facebook or any social media, or if you're just like flipping around, like you should be acquiring wisdom from a book.
I love that.
Or enjoying a great work of fiction.
Yeah, that's right. And so what does that do as far as, so here we are, we're cranking through those books. These are the beginners, your early days are just absorbing that information. Now that reminds me when I was young, and I've told you this story, so we'll tell it to the world. But when I was a young analyst starting out, just like you suggested to people starting out, I just finished grad school and I would take the train 1 hour each way. And I was just an analyst, like just entry level, nothing fancy, just a number in a company of 15,000 employees. I would picture the day that I was in an interview to be an executive. And I said, that day's going to come, right? I'm young. I'm in my late 20s and just finished grad school. And I would study old textbooks and I would study information. And I would just continue to say, I'm going to be the best at what I do. Not the best in the world. There's no ego. It's just, I really want to add value. And in order for me to do that, I had to become someone who could provide value. And so I stayed on top of that. I read everything I could get my hands on, from leadership to portfolio management to finance, accounting, derivatives, central banking, literally everything I could find, statistics, as you mentioned. And after a few years of that, 2 hours a day, 5 days a week for about 5 years, my next job was a CFO. And I literally made this like literally from the bottom of the metaphorical totem pole to the top.
5 years, yeah.
In 5 years. And that was all from that. And when that moment came that I envisioned 5 years before that, it was a shoo-in. And in that moment, you want to feel prepared. And that's a mind game that provides. And so based on that mind game, John, I'm curious of like, how does that help you? Like, does that help you with flow? Like, what does that do when you read that much in the early days? Yeah,
and I still read that much now, right? So yeah, and I'd say in the earlier days, I would focus a little bit more on my profession, right? And whether that was law or tax, I'd actually read these like tomes, these treatises on like estate planning and tax law and things. But what it does is it gives you perspective. And it like gives you more reps, right? So, you have your own career and your own experiences, and it's this limited set of data points. But when you read a lot of other things, there's all these things that you can bring in. I mean, Charlie Munger talks about them as being these mental models, right? Yeah. So he says, you need to create these mental models which are really ways of thinking and things that are true that you can fall back on. And like an example of a mental model, and it would be, wisdom would be, Warren Buffett's, be greedy when the markets are fearful and fearful when the markets are greedy. I mean, it's right because it's simple, but it's not easy.
Oh yeah.
Right. And you start picking up all sorts of things like that by reading, books and read books by, the great investors and again, biographies. And also, I don't want to think, there's some people that just read nonfiction. Like seriously, read some fiction too. It does these creative things in your brain. I had epiphanies about the world after reading a section of a work of fiction. But yeah, I think it trains you in a way, it's different than if you're, passively consuming TV or you're reading, things in the Wall Street Journal or on, different articles. I think it's a nice discipline and gives you a great perspective.
I love that. And, in my early days, and you keep me honest here, John, in my early days, I would pursue money, and I thought that was a noble pursuit, and it is to a point. What have you found? Have you found that to be, not only yourself, but also all of these ultra high net worth families that you speak with, all of these people who've had some very exceptional success in the finance area? What have you found to be true that you can advise beginners as far as the pursuit of money? Yeah.
So in my career, so I'm 53, so I'm not like super old, but nor am I like, starting my career. I'm kind of like on the, the planning for the.
Now you're ramping up, man. You're ramping up.
Yeah, exactly. But, what I've noticed both with families that I work with and just throughout my career at different places is that the people that focus on money are sort of, less happy and often end up being less successful, because when you pursue the money aspect, that's not always the best thing for you. Right. And it's interesting. My next book that I'm writing is about money and happiness. So it's related to my observations of spending 25 plus years in this industry with working alongside and getting like the inside view of these really wealthy families, but it's backed by a lot of research. And there's a number of paradoxes about seeking wealth. And the first is that more money is correlated with more happiness and more life satisfaction. And that makes sense. It's not a super strong correlation, and it starts, having diminishing marginal returns as you get more and more money. That makes total sense. Right. But, people that make $500,000 tend to be a little more happier and have a little bit more life satisfaction than somebody that makes $200,000. It's just that's how it is. But what's interesting is studies have looked at, but if your goal is financial success, you end up being less happy. Related to that, again, being successful in your career is great. Like it's really fantastic to be successful in your career. And it gives you, once you have success, it gives you self-esteem, gives you life satisfaction, correlates to happiness. But those that focus on career success, and like that's a big driving force. And, think of people are really ambitious, they're less happy and end up being less successful. And, Adam Grant, and I know, Ryan, you and I have talked about Adam Grant, really like his work.
Big fan.
One of his early books was called Give and Take, and it's about givers and takers. Mm-hmm. And it's fascinating. What he found is givers, so people that are wanting to put value out in the world without expectation of return and to help other people, they're less focused on themselves. Whereas takers are more ambitious, they're more calculating, they're more concerned with money and status and prestige, and they're more of a taker. What he found is that givers both were the most successful and the least successful. Right. So some givers can get taken advantage of. Right. And then you have the takers kind of in the middle. But across the board, the most successful people were the people that were givers. And I'll tell you, my career really took a shift back around 2010 when I decided, I remember I was running and I decided, I'm going to stop worrying about my career, how much I make, getting promoted, anything else. And I'm just going to focus on other people. Now, no one can do that 100%, but I'm really going to focus on the people at my firm, the younger people, bringing them along, training them, helping them, and up my game even with my clients. I'm going to focus on everybody else. And I was doing really well up until then, but at that point, like my career took off. And I think that's one of the hard things as I've managed people over time is getting people to understand that you will have greater career success if you focus on other people, put the company, put your clients first. Don't worry about yourself. All those other good things will come. But as a result, not as a goal. So, financial success should not be your number one goal. Career success should not be your number one goal. Do what you love to do and what you're good at. And all the rest will pretty much take care of itself.
I love that. So having money does show a correlation to happiness,
Absolutely.
But having a goal to have money as a correlation to unhappiness. Is that right?
Absolutely.
I love that.
And people may say, well, what about that study that shows once you have 75 grand and that if you adjust for inflation, it's about 90 grand. What if you have, over 90 grand, it doesn't add to your happiness. So two things about that. So number one, that study, a lot of people don't realize it, but the co-authors on that study, one was Angus Deaton, who most people don't know, but the other is Daniel Kahneman. Daniel Kahneman did that 75 grand study that's so famous, author of Thinking Fast and Slow, Nobel Prize winner in economics in 2002. But he, what they found in that paper, if you read it, first of all, is that life satisfaction continues to increase while happiness kind of tops out. So that's pretty interesting, because it's not like you can just get happier and happier forever, right? So that's number one. But then number two, there was a second paper by a different researcher using the same set of data. It comes from the General Social Survey, and he found that happiness and life satisfaction both continue to increase. Again, they increase less and less. It's a diminishing return, but it continue to increase. And in something that almost never happens in science or social science, Daniel Kahneman and Matthew Killingsworth, the other author of the paper, got together and did a joint paper reconciling the two. And what they found, this came out about a year ago, and it's got, of course, everybody loves the 75 grand paper, but the paper that corrects it has gotten no press, right? But what they found was that Kahneman's original paper, there's these 20% of people that are just basically unhappy people. And basically what happens is they get happier or less unhappy up until about 75 grand, and then they top out. But for the other 80%, they continue to get happier, right? So for most people, the happiness continues. And there's a study out of Harvard from 2018 that looked at the wealth of people, and they found that, people that have over 10 million are happier and have more life satisfaction than people less than 10 million. There was a study in 1985 of the Forbes 400. Not all of them, replied, but they found people that were on the Forbes 400 were a little bit, not a lot, but a little more happier than people that weren't on the Forbes 400. And it sort of makes sense, because when you have more wealth, you have the ability, first of all, to avoid things that are bad, not having money and
ramen noodles,
credit card, ramen noodles, all that thing. But then there's other things, like the things that you can do that do help your happiness, like buying experiences, doing things with other people, giving to other people, buying time. So I don't mow my lawn or do my leaves anymore. And I love that, there's all these other things you can do to buy time, and all that comes with more and more money. So this idea that money doesn't buy happiness, no, but if you use it correctly and you have your head in the right space in terms of, what you're following in life, the money actually can create more happiness. But the paradox is, for all the listeners, but you can't have the money as your goal. It needs to be the result of doing something that you love and that you're good at.
Yes, and be a giver as well. So a
giver.
I love that, and I say a serious thing in a kind of a silly way, but I often tell people, and I've told you this, John, when we've talked before, but being generous made me rich. That is literally the thing that changed it all. When I was a young man, just starting out, probably pursuing money, exactly what we said don't do. But
I did in my 20s too.
Yeah, right. Because you're just like, hey, I graduated school. I guess the next thing is go make a career and buy your house. And so there's a lot of acquisitions going on early in your real career. So you need money. But very quickly I realized, and that was it wasn't a tactic, it's just how I am, is I would generously provide. And I remember the first time that this worked, and the gentleman turned into my mentor. So he's, 6'3", 9 kids, worth $100 million, had gold mines and oil wells and engineering.
Why does 6'3" come into it?
I don't know. Just large, he's a lot. So
how tall are you?
6 feet.
Oh,
yeah. So, he was just, I'm just like, who is this guy? Like, literally you're an outlier in everything. And so when I talked to him, I found out that he was building a 132 megawatt power plant in a local area. And so I said, hey man, I just graduated this guy could have hired Deloitte, could have hired anybody. I said, hey, I just finished grad school. I will build you the nicest financial model you've seen. I mean, not only will it be accurate, this thing will be a piece of art. Like, you will be super pumped to show this to your investors. This will be beautiful, and it'll be effective and dynamic and all these things. And I said, the best part is I won't even charge you. Which, trust me, at the time, I really wanted to charge them. But I said, look, I would just want to learn from you and your investors and your other partners. And so I walk into this room, there's billionaires, there's finance emissaries of the Saudi crown prince. There's all these people in this room, very interested. I show them the model, blow their mind. All that stuff happened. But the point is not what I did, but how I got in that room was from being a giver, exactly like John said. And this guy was so impressed, and I knew he would be, because I gave him everything I had, every ounce of education that John talked about filling your mind with. I gave him everything I had and charged him nothing. And I show up at his office in the biggest boardroom I'd ever been in, and it completely changed my life. Why? Because I chose to give. And so by giving, and that was the moment, friends, that two things happened. Not only did I realize that my generosity was an asset, but I also realized that it can actually change your career. And in that moment, that change happened was finding money was no longer my goal. This is exactly what John's talking about. Just hit me, brother. I love it. So by not making, so pursuit of money can be okay. Having money is great, but don't make it a goal, I think is what we're hearing if you want fulfillment in the early days. I love that. Now, for the beginners, how do you not lose? How do you not get your clock cleaned in the early days?
Yeah. So I think a lot of it is like, losing is more like a mindset, right? Like you're going to have, failures. And, I shared this story with you recently, Ryan, that, my freshman year in college, I went to TCU and I made a 1.8 and a 2.4, lost my academic scholarship, and my parents yanked me. And it was like, at the time, I thought it was like the worst experience of my life. And then looking back, it was one of the best experiences. And, we just discussed how my firm came out of the ashes of Arthur Andersen. At the time, I'm like, this is horrible. My company's going under. What am I going to do? But I wouldn't have had the opportunity to start this company without having that horrible thing happen. And so I think it's how you react. And a lot of times things that are negative end up being the most meaningful. There was this, fascinating study where they took, they surveyed all these people and they said, think back to something that's happened at least more than 2 years ago that was really positive. And how did you feel about it then? And how do you feel about it now? And then how meaningful is it now? And the same thing with negative. Think about a very negative thing. How did you feel then? How do you feel now? How meaningful? And what they found is the positive things don't feel as positive now. Makes sense. And the negative things don't seem as negative now. So like we have something that is known as having like your emotional immune system, right? So we think that if something bad happens, it's going to be horrible, and it can be horrible, but we adjust to it is basically what happens. But then what they said is how meaningful did you find those negative experiences? And with a huge margin, people found in general, the negative experience is the most meaningful in their lives. And I think that's really something to hold on to when things don't go your way and you fail, and you will fail, and hopefully you learn from it, but then realize this will be, something that will end up being a positive, or I'll take great meaning from it later. And it's interesting. I have two kids, 21 and 24, but, I have a very big interest also in like, how do you raise kids in affluence, like for our families. And Clayton Christensen, who was a Harvard professor and wrote the great book, The Innovator's Dilemma. But he also wrote a book, How Will You Measure Your Life? And in there, he talks about the fact that as parents, that what maybe you should do is help curate failures for your kids. And think about, like, regardless of how old your kids are, whether you're talking about a 5-year-old or a 15, 20, 25-year-old, be thinking like, what sort of failures should they have in order to be a competent, fulfilled sort of person? And as bad as it is, you'd be like, oh, well, I want them to date people, and I want at least one heartbreaking breakup. Like, can you imagine like the first, person that you meet and start dating, you end up marrying? Like, no, you need some breakups, right? So exactly. You think about that as a parent of all the things. And, parents are always like, oh, I want my kid to make all A's. No, like, it's great to have your kid bring home a C and have to struggle through that, and redeem themselves and try hard to get that grade up. Right. So it's, or even a D or an F. I made a few at TCU. So yeah. So I think the way you don't lose is expect failure and plan ahead about, how you're going to handle it, and realize it's going to be, likely this amazing, resilient experience.
Yeah, I love that. And, you remind me of, I have children a little bit, quite a bit younger than yours. So I'm just getting started, buddy. But one of the things I told my wife, just from a male and a father perspective, is I said, I believe in talking about raising people in affluence and the pursuit of billions and raising children in that environment. I said, I believe in the concept of what I called controlled struggle. Yeah. And by that, I mean, as a father, my job's obviously by control. I mean, I scrub any scenario of danger, but I don't scrub it of struggle. Because there was an old movie from the 90s, I remember, I believe it's called Higher Learning. And in there, he talks about without struggle, there can be no progress. And I've never forgotten that 30 years ago. Without struggle, there is no progress. But with danger, there's no progress either. And so as helping people understand that. And so here's what I found, right? So people listening are like, I don't have kids. How does this apply? Let me tell you, subjecting yourself to your own controlled struggle can help you level up. And so when that time comes that John and I are talking about, that you just get your clock clean, right? You tried everything and it just didn't work out, right? Like for your moment with Arthur Andersen, we all have these upsets, whether it's in romantic relationships, in our careers, whatever that might be. That moment may be coming, or it has already. But one of the best things you can do, not only for yourself, but to prepare your children, if that's who you are in your life, one of the things that I have found extremely helpful is by subjecting myself to my own controlled struggle, so that when that day comes, or if it comes, either one, that you are not uncomfortable with struggle. Now, danger, that's a different story. That's not what I'm talking about. Obviously, keep yourself safe.
And this is so wise. And what the psychologists, educators say about this, what they call it is allow your kids to have affordable mistakes. It's exactly what you're talking about.
Yeah. Yeah. So I run every morning with my 7-year-old son in the Canadian winter. It is cold, but we're properly prepared, and it's controlled struggle. It's not dangerous, and it's controlled struggle. And literally yesterday we had two people roll down their window and be like, "You guys are awesome. What are you doing? It is like minus 30 right now." So aligning to that, not only does that allow you to really have a good sense to say, look, if you want to be healthy, if you want to get your money right, first be okay with being uncomfortable. Now, that being said, I did tease the audience that we're here to talk about institutional capital as well. So we talked to the beginner. So let's really punch this thing up and get into the institution sphere. So that being said, let's start with the market. What are you seeing out there as the chief strategist of a $15 billion trust? What are you seeing? What's your predictions? I know you're in Forbes all the time. What are you seeing out there? Yeah,
so really, and in my book, I have like an entire chapter on predictions and expert predictions. and I'll tell you, so the market, the stock market and the economy, and even politics, it follows something what's known as a complex adaptive system. And what a complex adaptive system is when you can't tell the nature of what the output's going to be based on the inputs. And this happens because in the stock market and the economy is because you have all these intelligent actors, people, firms and everything that learn, and they can change their behavior. And they change their behavior because of things that happen externally. And then they're watching everybody watch everybody else. And then it creates real effects that cause feedback loops, right? So, if you think back to AMC and GameStop and everything, right? So basically, you had these people on Reddit, I think it was, that decided, okay, let's make the stock go up, and they did, and then more people were buying because it was going up, right? And there was no fundamentals. They're just like, we're going to buy because other people are going to make it go up, right? So we've all been there where this sort of thing happens, but then it caused real effects, like what AMC did, which was fascinating, is they raised more capital, and it probably helped them survive because these people on Reddit ran the stock up, right? And then there's this feedback loop then of people seeing make money, so they make more money. So anyway, that's kind of how the stock market operates. And what it means is that it's inherently unpredictable. It just absolutely is. And nobody was predicting the pandemic when it happened, or a stuck boat in a canal, and people were expecting the war with Ukraine. And when it happened, people thought it was going to be over really quickly, and they didn't. The what's been going on with Israel and Hamas, that wasn't predicted. None of this was predicted. And it kind of reminds me of, back in 2011, there's an investment manager we use. It's Deep Value, and we use their international product, right? And I remember 2010, they were like, oh, we're overweighting Japanese stock because we think they're undervalued. We think Japan's really, set themselves up nicely for growth, and they're just going to do great. So, we're doubling, the IFA in terms of our Japan allocation. And of course, in March of 2011, there was an earthquake that caused a tsunami that slammed into the coast, and the Fukushima, reactor, and, it had all the devastation, and basically it tanked the economy and the Japanese stock market with it. And a few months later, we had a call with this manager, and we were, kind of nicely, we're not dicks. We're, we're from Missouri, Midwest. It was Midwest Value. So we're kind of you shit the bed, what a bad call. And they're like, no. It was a great call. How were we going to predict an earthquake? And the point here is they're missing the point. You don't get a mulligan because earthquakes, wars, pandemics, terrorist attacks, boats stuck in canals, you don't get a mulligan for that. That's the point, right? That it makes it unpredictable. So what we tend to do is say, we don't know. And the power in that, and I'll tell you, it works extremely well. So we're working in the mainly 100+ million family crowd, and we're going up against all the time, the Goldman Sachs, the other big wirehouses, Bessemer Trust, other multifamily offices. And what we say is, we don't know what's going to happen, and we're going to invest like we don't. And everybody else is going to be running around predicting this or that. And they continue to predict, and they continue to predict. So long-winded answer of saying, we don't know. But I will tell you, based on past history, so if you go back to 1926 and you roll it forward, the stock market's been up 70% of the time. I just wrote an article in Forbes on this, and what my stock market prediction is. And my stock market is, it'll probably be up because it's usually probably up. And it was my same prediction, by the way, the 4 prior years. Right every single time. because I said it's probably be up, but it might be down. So even in 2022, it was down 18%. I was like, well, it could have been down, and it was, right? So it's actually, really useful to keep, to keep that in mind. But you may be like, well, what about when the stock market's up 20+%? Well, when the stock market's up 20+%, the following year, the median return is 11.1%. And it's up about 65% of the time. So again, don't know. What are interest rates going to do? Don't know. If you put a gun to my head and said you have to bet, I'd say I think they'll probably drop this year. But most people didn't see the historic 5% increase in interest rates over, by the Fed over 15 months. They didn't even see it. They didn't predict this. And if the Fed can't predict interest rates, then how can you? And if you work with a financial advisor and investment expert, ask them, what do you think interest rates are going to do? And if they tell you, you should almost be like, not the advisor for me. Because they probably didn't say 2 years ago, we're going to see this historic rise in rates and it's going to give us the worst return in bonds in the history of the world. They just weren't. So my answer is I don't know.
I love it. So it might be up, it might be down. I love it. In all seriousness, you do bring up a good point, is to say, hey, and you skip past it. And I don't want to miss this, folks. So what John said is, hey, we invest. We just no ego. We just say, we don't actually know. We can't predict everything. You don't get a mulligan if there's a war or some inflationary event or an earthquake. So if you can actually admit you cannot predict it to any serious degree, and you change your investment thesis to reflect that, to say we invest as though we don't know. We know finance and we know what we're doing. We can find, where's the profit and the growth rate. So we can get a sense of how much meat is on this bone, as I like to say.
Yeah.
But in reality, when you're looking at the systemic risk or the beta, or for, some of you quants out there, I know I see you. So some of you predicting some of the systemic risk is saying it's really hard to predict that. And so if you change your investment thesis to reflect the fact that you're saying it's hard, but that doesn't mean we can't invest. It just means we need to stop trying to make individual calls and start trading more on macros and around that, and just say, look, it could go up, it could go down. This is where hedge funds sometimes come into effect. But regardless of how you manage the known unknowns, there's also unknown unknowns. And appreciating that whole sphere is high finance. It is maturity in your investment thesis, and it is how you manage a $15 billion family trust. I absolutely love that. So it's anyone's guess where the market's at, where it's going. So I absolutely love that.
Yeah. And this doesn't mean that you can't be smart about, investing.
Yeah.
I mean, because a very powerful law of the universe is regression to the mean, right? Mm-hmm. So it's not like you can't, you just sit there and you do nothing and you throw your hands in the air. And the fact that the market will probably be up this year, and over the next 10 years, it almost certainly will be up. And over the next 20 years, it will definitely be up. And again, I say that obviously, we could have, something that, we could be sitting like we're in Japan in 1989. So I'm not saying that the past is an absolute law, but just playing the probabilities, it's almost certainly going to be up over 20 years and 10 years. But it's not that you can't do anything, but it does tell you that if you're sitting on cash, you probably shouldn't.
Yeah.
And I'll tell you, so I have a buddy that his family, they sold their company in early 2023 for a lot of money, hundreds of millions of dollars. He started his own family office that he runs. And he's a super, super smart guy, but he was working in the business before. And even though he has a business degree, he doesn't have a lot of hands-on experience with investing. So I've been helping him. Right. And so, we put together, some asset allocations, and I introduced him to some different, investment managers and things like that. Our firm, we often work with families when they have an exit from a business. That's the number one reason. Hopefully before the exit, because we can help with some, more of the tax and estate planning and even the psychology of it. But, sometimes it's afterwards. So, in our 21-year history, we've helped families invest, I don't know, $5 or $6 billion of cash. So it's a ton. So we've seen what works and what doesn't. And really what works is, you typically, even though the odds are in favor, let's just go invest it all in one day. But it could be like, oh, it's March of 2000, or it's, it's October of 2007. So, if it's your one big bite at the apple, you're better off usually spreading over a year or 18 months or something. So, the best way to do this is you pick a day on the calendar and say, I'm going to do this percentage this day and this percentage this day and this percentage this day, kind of over your time period. And then you do it come hell or high water. Okay. So in helping my friend, his third tranche to invest out of, I forget if it's 4 or 5, but his big tranche to invest is on Halloween. And at every tranche, we have a morning call. And I say, come on, Dave, you're going to do this. I know it's scary. I know it's hard. Trust me, do it. So on Halloween, we have this call. He's like, I'm not going to do it. everything's horrible. Remember, the interest rates were going up, and it's like, are we finally sliding into recession? The stock market was, way down from its, midsummer high. And he's like, I don't see any reason why I'd invest now. And I said, I don't either. I don't know what's going to happen, but I do know that you can control yourself. You have to follow the discipline. Come on, hold your nose, do it. He did it. And look at what happened in November of 2023. The stock market had one of its best monthly returns in 30 years. And so we talked on December 1st, and he said, thank you so much. Like, this has been amazing. My family made so much money this month. And I'm like, I know. And it just shows you cannot possibly know. And I'll tell you, I don't know if I could have done it if it was my own money and it was tens and tens of millions of dollars. But I'm an advisor, and I can advise and I can help people do the right thing. Right.
Man, I love that.
So the point is, it's just really hard. It's really hard to know what's going to happen.
Yeah. And investing like that and appreciating that fact can really help shape a very effective thesis. So as we round third base, let's really help our listeners to level up, according to John Jennings. So what would you say are 2 or 3 things that you could really leave behind as far as cheat codes that really help people understand, I don't know, raising capital, how to allocate it, anything at all?
Yeah, I'll speak as somebody, and it's like you said, we're sort of like an institution. We're the way we invest is closer to institutional than if we were a single family office. So let me explain a little bit of psychology of like the difference between an ultra high net worth investor, or maybe someone that has their own single family office, and then like us as a firm. So like if I was like one of our clients and I had my own single family office, like I could direct how things were going to be invested or hire somebody, to help me do it. But if something did really poorly, like I wouldn't fire myself because it's my money, right? And if I do a direct investing deal, invest in a business that goes to zero, I'm like, well, I tried, right? Yeah. But when you're investing money for other people, there's 2 things at play. First of all, you feel like I feel a deep sense of responsibility for our clients and their assets, and like when it's down, like I feel really bad, and I feel really responsible. But a second thing also is like we're also in business to make money, and people tend to have short memories. And like, if you're down too many years in a row, you get fired. Or if you put them in and say, oh, let's put $1 million into this, this restaurant, how do you create a small fortune? You start with a large fortune and you invest in a restaurant. No, but, or whatever business deal you do and it goes to zero, like you as an advisor also running a business, you're like, I don't want to get fired. Right. So you're in this situation where you're not going to invest the same way maybe you would invest yourself if you were in their shoes doing it for yourself, right? Because so what we do is, we're more methodical. Like when we do private investing, which we do quite a bit of private investing, but we're like, okay, we're gonna invest in funds. And we're going to diversify vintage year and type and style. We're going to have our buyout and our growth equity and our venture capital and our private real estate, et cetera. And we're going to do this. And we're typically going to invest in funds that have a track record, that have worked together, that have shown some success, because even though there's basically no persistence for public stock managers, from one period to the next, there's pretty high persistence for, private managers. And so it makes it a challenge. So for newer funds, it's really hard to get someone like us to allocate to you, because even if you're going to be fantastic, there's more risk for us, not just for our clients, but also for our business. Right. And it's why if you hire somebody else to invest your money, you're going to get returns that aren't like this. They're going to be more like this. Right. And it happens with, stock managers, people are buying and selling stocks. I mean, I see this over and over again is, they'll give up on their discipline before they'll get fired by everybody. It's like we had this manager. This is a great manager. We used them for small cap growth, but they were a GARP manager. So it was growth at a reasonable price. Right. And, I forget the years, probably like 10 years ago, but they had been producing all these really strong returns, beating the small cap growth index. This was back when small caps beat large caps. So it was great. Like it was amazing. And like one year they like this 55% return, and the next year, not good. Next year, not good. 6 months later, not good. And it was because that small cap growth during this period, a lot of tech and biotech companies were really leading the returns, and growth at a reasonable price means that you're not really going to buy companies that don't have, positive earnings, which a lot of these companies had. And they sub-advised to a mutual fund company. So they managed $3 billion. $2 billion of it was with a mutual fund company in a few different funds. And the mutual fund company fired them. And they went from $3 billion to $1 billion. Yes. And their people started leaving. Yeah. So we fired them.
Oh boy.
And everybody else fired them, and they went out of business. And this is a manager that had a very good process and discipline. They were great. I have like little doubt that they would have returned to do really good in the future, but they went out of business. And it's because they stayed by their discipline too long. I mean, and yet that's what you have to do to outperform. And we actually prefer, even on the public equity side, where we're going to do an active manager, a lot of them have lockups. People are like, why would you do a lockup with a public stock manager? And we're like, because it allows them to do what they see is the right thing to do without having to worry about, clients, pulling money out. So, so just realize that that's part of the reason it's so hard to raise money, from institutional, and why they want that. And it's why, you see big pension plans, and they're only doing, the KKRs and the Apollos and the Carlyles and everything. And it's because, first of all, they have a lot of money to invest. And second of all, it's a sure thing. They're like, we don't care if we're right around the median in terms of private equity returns. It's good enough. And, we don't want to take the risk of, going with a smaller or newer fund.
Man,
the world works.
Yeah. And, you and I have talked about it, and you've told me a little story of a study that you read about endowment funds.
Oh, yeah.
Yeah. And
no, actually, I did the study.
Oh, you did the study. Okay. I missed that part.
So what happened is everybody wants to invest like, the top endowment. So it's called either the Yale model or the endowment model. Yeah. As you pointed out, Ryan, you have the book, David Swinson, he was the chief investment officer at Yale. So he published it in 2000 and basically said the way Yale has been able to be the number one endowment and, really provide these just amazing returns is, we do less in fixed income. We do more in alternatives, especially like private equity and venture capital, private real estate, these people running around buying, timber all over the world and things like that. And what happened is people wanted to emulate that. And they're like, oh, here's the recipe for higher returns, right? And I think it really made its way, beyond just the nonprofits, the endowments and the pensions, and it made its way into individual investors. And I think what's fascinating about it is, if you go to your broker at, Morgan Stanley or whatever, and I could pick on any of them, like, what are the chances that they're going to put you in the sort of stuff that Yale does or Stanford or, Penn or, Washington University, where I teach, has been in 2 years ago, they were the number one endowment return. They've been in top 5 each of the last 5 years. And like, But what Swinson said when he did the second edition of his book in 2009 is very few institutions and even fewer individuals can afford to put forth the resources or have the access to replicate these sort of returns. And so what I did is there's this study that comes out every year from NABUCO, which stands for the National Association of College Business Officers, and TIA from TIAA-CREF. And what they do is they survey, I think there's 735 university endowments, most of which are north of $1 billion. And they say, what are their returns? And I did this a year ago, so I haven't updated it for the last fiscal year returns. But what we found is I took a simple 70-30 index portfolio. So it was the All Country World Index ex-US. It was, the basically Russell 3000 and then the Bloomberg Ag. So those were the three things, 70-30 equity fixed income, and then compared it to both the median and the average returns of university endowments. And they were indistinguishable, exactly the same for 1, 5, 10, and 15 years. I mean, within 10 and 20 basis points. And what that tells you is for every Yale and WashU and Stanford and Penn that's out there that's, killing it, you have all these other institutions that aren't, and realize that they all have professional staff and or have, expert consultants, and everybody's running around trying to generate, outperformance. And really all they had to do was have a 70-30 and they'd be at the median. And in fact, the chair of the Washington University's endowment, he actually lives out in San Francisco, and he used to be the chief investment officer at Stanford when they were, the whole time he was there, they were, a top 5 returning endowment. And, what he did is he came in, Washington University was kind of having these, kind of median returns. And he basically fired everybody, hired a new chief investment officer and staff. And name's Eric Upin, amazing guy. But he said one of the things they really look closely at is whether they should just do a 70-30 index. And then they ran some numbers and said, well, what if we levered it, 1.1 times or 1.2 times? And like if you levered a 70-30 index portfolio 1.2 times, again, they'd be at, you'd almost be guaranteed to be a top, decile university endowment is what you would be. So it's pretty fascinating. And there's another paper that was done called "What Would Yale Do If It Were Taxable?" And it said, yeah, the Yale model and these endowment models are great for, nonprofits like these university endowments or pension plans. But what happens if you have to pay taxes? And what they did is they reverse engineered based on Yale and the returns and their asset allocation, like what their assumptions were. And they said, now let's add in taxes. And what they found is that they would greatly increase their amount of public equities, especially their index funds, that they would get rid of their hedge funds. And basically it was this much different allocation than the university endowment. I think one real blind spot in the industry advising ultra high net worth clients is advisors don't see the taxes usually. Like, we're a multifamily office. We are very involved in getting the taxes done. We review all the tax returns. We see them. We give our clients reports on taxes. And unless you're seeing it, like, you can look at a gross of tax return. You're like, oh, that's, pretty good. So even if you're doing the endowment model and you're, right at that 70-30 or maybe a little better, you're like, look, we're killing it, But the thing is that after taxes, if you're investing like an endowment, it's like a bloodbath, right? So I think every time you look at anything, you got to say, I'm going to tax adjust it. So like we invest almost nothing in hedge funds, and it's because of how tax inefficient they are. I mean, I can't say we never invest in a hedge fund, but we're really skeptical of the hedge fund because of the tax hit. And there's different types of alternatives. So again, private credit's a big deal. And again, you gotta run what the taxes are on private credit and say, is this worth the lockup on an after-tax basis, right? So I think that's incredibly important when you're working with ultra high net worth investors as opposed to a nonprofit organization.
And just to echo on that, I'm sure you get maybe some emerging fund managers. I'm just hallucinating here, but it would be putting myself in your position. And so when you've done this study and you find out, say, really active management, it really comes down to a 70-30 was some of that from the endowment side. And then you may have so we're talking about pitching people like yourself. And so if these managers come in and they're like, we're going to outperform the market, I would just imagine you, if I was in your shoes, I'd be like, really? Okay, I got to hear this.
Well, to outperform, you need one of three things.
Yeah.
Okay, here's the three things.
Yeah, fine.
You need to have better information than the market or the other people.
Yeah.
You have to have better analysis, or you have to have better behavior, right? Mm-hmm. And on the public stock side, and I like to ask this to public stock managers.
Sure.
Which of the three do you have? And it's almost impossible to have better information in public stock, right?
Yeah.
It used to be the case that you could get, you could get better information. That's basically gone now. So it's not better information.
Yeah.
Better analysis. Okay. So some firms are like, we have better analysts. We do better analysis. Maybe. But the problem is that we only know our experience, and it makes us overconfident. And we know that we're good and we're smart and we're doing a great job. But like the seat we're in, we through my career, I probably talked to, 400, public stock managers. And at first, like the first one you meet, you'd want to give them all your money because you're like, oh my gosh, you are so smart. Your analysis, your style is so good. And it'd be like if you ever met one NFL wide receiver, you'd be like, oh my gosh, this guy's going to be like MVP. Like, he's tall and he's fast and he's strong. He's got these great hands. But like once you've met 100 wide receivers or 100 cornerbacks or safeties, right? You're like, oh, dude, they're all playing against each other. Yeah. Right. And that's how we kind of are with these public stock managers. Is it's really hard to have better analysis. And once you meet with 10 or 20 of them, you're like, okay, they do have some differences, but they're all really smart. Okay. So really what you're left is the better behavior, right? And where we tend to hire public stock managers is where they have the behavior piece and they say, yes, we behave better. And that's partly where the lockup comes in. Mm-hmm. Like, it allows them to behave better because they don't have to be subject to the whims of their investors taking money in and out. And the same thing is true in private investments. But there it's a little different. Like you can have better information, right? And maybe in a particular industry, and again, it's because, if you're going in to buy a company, like if you're in the business of buying companies and you're buying from a family that has had one company and this is their one sell. And a lot of them are like, oh, I don't want to pay an investment banker. Right. Bad idea. You should have an investment banker, right? Like I see it all the time. Our clients are like, oh, we're going to sell our business. We don't think we need to pay, 3, 4, 5% to investment banker. We're like, no, you absolutely do. You will absolutely get your money's worth because, there's this almost information asymmetry. Somebody that's used to buying businesses versus somebody that doesn't usually sell businesses, and you can know more about their business. And this is, it's not insider trading. You can dig in and so there's this ability to have better information, maybe even better analysis, and definitely better behavior in private investing. And I think really as if you're a private investment manager and you're selling into someone like us, it's really explaining, kind of what that is and, what's your differentiator? Like what are you doing that's different than just the guy down the street? And, can you prove it's correct? And, a key thing that we look for, especially for like an earlier fund, is, really the quality of the people.
Yeah.
I mean, we're investing in people always. Like that's who it is in private investment. You're absolutely investing in the people. And like we have these 10 things that we go through, whether it's a direct investment or a fund, like these 10 flags that we look for. Number one is the person. And, the whole Peter Thiel thing in his book 0 to 1. He talks about like secrets, and it's in the blue section. I know
a lot of blue books in my background.
It's a blue book, but he talks about secrets and and Ben Horowitz of Andreesen Horowitz does this great. You should Google it. He did this commencement address at the Columbia University School of Engineering. I don't know, probably 8 or 10 years ago. But he puts it so eloquently. He's like, if you come to me at Andreesen Horowitz and go, I have this great idea, and my idea is something to make batteries last longer in like cell phones. He's gonna be like, that's a great idea, and I'm not going to invest because everybody thinks that's a good idea. Panasonic and Sony and Samsung, everybody's all working on that. But he tells the story of Brian Chesky when he comes in. He's like, I have this idea, and it's I'm going to rent out an air mattress in my guest room. And he's like, and my secret, Ben Horowitz tells us so much better. But my secret is, it used to be that there were you only traveled kind of like by horseback, and you knew the quality of the inns kind of around your area. You'd ask around. Mm-hmm. It was only once we had, cars and airplanes and trains and everything that you needed like Howard Johnson's and Hilton's and Marriott's. So you know the quality of where you're going to stay. And we don't need that anymore because we have the internet, right? So you can have pictures and reviews. So, that launched Airbnb. And like Ben Horowitz was like, when I first heard this, I'm like, this is a horrible idea. But he invested because it was different. So the key there, and what we tell our clients all the time is like, our clients will get excited by an idea. We're like, you don't know what a good idea is. If it sounds like a good idea, it's probably not a good idea, right? So what that leads you to, like in our 10 things, the idea is number 10. So the people is number 1. So you're investing in the people, and you hope the people have the crazy ass idea, like luxury electric cars or build your own teddy bear, like something that sounds so ludicrous, but you're investing in the person. And like build your own teddy bear. I say that because Build-A-Bear is based in St. Louis, and the person who created it had this long career in retail, right? And like she knew retail like so well, had successes, had failures, and people were like, we're going to invest in her, even though the idea seems crazy. Like, why would you pay to build your own teddy bear? And obviously it took off. There's like 5,000 stores.
Damn.
So that's really what we get into. And so it's the people. So how can you put your people forward? And I'll tell you, a key thing is if you have a fund, we love, the number one thing is, do you have a lot of skin in the game? One thing we'll love is like, if a fund comes in, and I understand early fund, you're not going to have like this much wealth. But when a fund can come in and they're like, 10 or 20 or even 30% of the fund is made up of employees and of the GP, we're like, okay, that's awesome. We love that. Or if it's, you're newer, but you're like, yeah, basically almost all my net worth is tied up in this fund. Like, we want to see that skin in the game. It means that you believe, because the thing that I think is, really damaging about this industry is and the industry, just investment, wealth management, is it's all about playing with other people's money. Right. And if you're like, no, it's my money too. That's so key.
I love that. So having skin in the game. Now, when it comes, so we're kind of dancing around this, and I want to dive a little bit deeper. So if somebody comes, right? So we have a lot of emerging fund managers that listen to the show, entrepreneurs, anyone, especially anybody raising capital. That could be any of those groups. And so when it comes to pitching a family office, what have you found works or doesn't work? What advice, not only from your personal experience, but maybe as someone trying to pitch you, what have you found nailed it and blew it?
Yeah. So I'll say, like, I get so many emails a day. And again, we're a multi-family office. So we're out there, like, we're marketing. We have a website, we want to gain, we like to add 3 to 5 client families a year. So we're in business. Single family offices are very, different. They're very, usually very private. It's hard to get any information on them. You're not going to know how much money they have. So, like Ryan started out to say, like, we're a little bit more like the institutional money, but I don't know how many emails a day from investment managers, and also, plane charters and art people and all this stuff. And I get it, but like, I'm not going to answer those emails, because if I spent my time answering those emails, I wouldn't have any time, like the cold calls, the cold emails, like, they don't work. Like even if somebody's like, oh, we're delivering these amazing returns, I'm like, yeah, everybody has amazing returns, at least in their marketing or, in their past, this one strategy or whatever. Like, I'm sort of skeptical and a little cynical. Right. And the only time I will actually even read an email or respond to it is when they start, like, in the subject line or right away. Like, if somebody sent me an email and said, basically the subject line right away, I read your book and I thought it was fantastic, and here's 3 things I learned, I'll be like, oh, he spent 5 hours reading my book, I'll spend some time, interacting or whatever. Or, I have this I have a blog that I produce, do twice a week. People are like, oh, I read your blog post on blah, 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 I thought that was great. I'm like, oh, it's making more about me. Or if they're like, here was what we can do for your clients. But still, like, even that with emails, I can't think of a single like person that emailed me, even if I responded, that we actually even took a deep dive to allocate capital. It's because there's so many other things out there. And as great as you may be, there's a lot of other greatness,
Mm-hmm.
and it's hard to, separate out, what's what. And then, I go to some of these conferences that are like, oh, this family office or the family wealth conference, like truly single family offices are almost never there. Like they just aren't. Like the only time I'm around, a bunch of ultra high net worth people that have or want to have single family offices, I'm involved in, YPO Young Presidents Organization. I'm YPO Gold. I'm over 50 now, but we have a family office network, and I'm involved in that, and there's very strict code in like YPO that like, you're not there to market, you can't sell. Right. So if somebody wants to contact me, great. But like, I'm not going to go get the list of people that were there and start like pinging them with stuff or whatever. It's about, relationship building. So, really the way that the times that, we've actually met with a manager that, kind of reached out is when it's through someone we know or one of our clients. So like, I've met before where a lawyer has said, hey, would you meet with these people? And I know what the kind of the lawyer's doing, like they'll have some sort of vested interest in this investment manager. And they're like, hey, we're coming to St. Louis. Do you have anybody to meet with? And it's kind of more of a favor to the lawyer because it like makes him look networked and good for them to come in and meet with a firm of our, size with the sort of clients we do. And so I'm kind of doing it, the lawyer's like calling in a favor. Right. But our clients all the time are bringing stuff to us, and we'll look at it and we're like, yeah, we'll give it an absolute shake, but it's got to kind of come through a client because we just don't have the time or the bandwidth to be just, wrestling down everything that, we get pitched or, pings us. So it's really a relationship business. And in terms of getting into single family offices, it's just really hard. They're really private. Like we have some clients that have single family offices and we like kind of fill in the gaps and, support them. And, we'd love to work with more single family offices, but there's no like great list out there. And even if there was, I know enough not to be like, oh, we're just going to email single family offices. So, really for me and why I speak at a lot of events is first of all, I love to speak, but I want to be like, okay, I'm going to give value out into the world. I'm just going to put it out there. And if my message resonates, give me a call. But like, I'm not pinging anybody, right? And it happens sometimes. But what I had to do is I had to do a lot of study and research and spend a lot of time. And I've used speaking coaches and I practice, 8 or 10 times before I give a speech, like straight through, because I'm like, I want to create an amazing speech where people learn a lot and they come away going, I really learned something. And if nobody ever calls me, that's totally fine. But that's kind of how we've tried to get into, the ultra high net worth single family offices. I mean, most of our, we're almost exclusive referrals. We rarely get calls just like, oh, I heard you speak or I read your book. I mean, it happens, but it's mainly, we share a family with a lawyer and then they have another family and they're like, oh, you should call, St. Louis Trust, or an existing client. Oh, you're exiting your business. You should go to my advisor. They work with families just like ours.
Awesome. And cold calls, sounds like cold calls don't work. And you and we've exchanged some scar tissue on this one, but very often, and same with me, folks. So I obviously invited John just through our own relationship, but often, having a top rated show or a large institutional thing, it attracts people in that industry. And often, and it's the exact same thing, if I can echo what John's saying, even from my own experience, a lot of people want to support me and help out, and it's so kind of them to do that. But it's just not possible for me to answer everybody. So the ones that get an answer, and John, feel free to disagree on this from your experience and on your side, but the ones that I give an answer to is exactly what you talked about, man. They lead with a give, right? We talked about being generous and being a giver, and some of it, someone's like, hey, I've been a big fan of your show. I went ahead and gave you a review, and it's an honest review. I love it. My favorite episode is this, where you talked about that. And I was like, what am I talking to, is this fan mail? What's happening right now? And yeah. And so they actually talked about it, and they were a PR rep and they wanted someone to come on my show. And I was like, absolutely. Now, obviously, they still have to meet some requirements, but the ones I get is they led with a give. And even if that's a compliment, that's they like to social media post, if that's who you are, whatever it is, find a way to add value, to contribute, to add anything at all, right? Like, John, I read your book, John. I really love this chapter where you discussed XYZ. And that reminds me of a thing. I'd love to talk to you about that thing. Oh, okay. Well, you definitely have my attention. So I can't impress this enough. And the other thing that you alluded to, John, and I don't want to gloss over this just for our listeners' sake. You and I know what you're talking about, but I really want to really underscore this, is that some of these events are a waste of time. Now, last May, I was with Ed Milet and Jim Rogers and Jen Gottlieb and all these people on stage. And there's about 35.
Yeah, some are great. Some are great.
Yeah, some are great. And I was on stage and I said, I totally set him up for this, but I said, who here has been to a local networking event? 3,500 emerging fund managers. Everybody raises their hand, right? That's a lot of people. It's a good sample size. And I said, who here's raised money from those? I swear, John, you could hear a pin drop. Not a single hand went up. And I was like, why do we go to these things? And the reason why we still go to these things and don't raise any money or don't progress our business or whatever it is because everyone there is just as bad as you are. Everybody's going to take. And so guys like John or guys like myself who are allocators, we don't go to those things because everyone's like shoving their business card down your throat. They hire me to be your accountant, your lawyer, your dry cleaner, your personal trainer, your landscaper. And you're just like, oh my gosh, this isn't even fun. Yeah. And so these networking events are not great. If you're trying to find a family office, you might, sure. But in finance, we play statistics more than calculus. So the probability in what John and I are saying, it's probably kind of low going to these networking events. So how do you get in the room with a guy like John? Well, he just told you. I just told you. Start with a give. And it doesn't have to be money. It doesn't have to be a gift. Probably that would be weird, but something sincere. That is what we're saying is show us that you've paid attention to our firm. Showed us that you've paid attention to me. Like we're very easy to do due diligence.
Yeah.
And so doing that and leading with a give and that spirit of generosity, I'm telling you folks, and John is telling you the same, it can literally open doors for you. Would you disagree?
No, I totally agree. I think it's great. It's absolutely, and it's tough sometimes. Like, how do I act as a giver? And I think it comes back to the, almost, don't put seeking money or seeking status or, fame as your thing. Like
we can smell it on you. If it does,
you can totally, as you put it, smell it. Absolutely. So, I think it's so important to be like, be passionate and believe in what you do. And, it's interesting. There was this article that was published, I don't know, a year or two ago, and some sort of a periodical for like people out in Silicon Valley. I'd never heard of it. Somebody forwarded it to me. It was called Choose a Good Quest. And it was really these two people wrote it. And it was kind of a screed against a lot of people in Silicon Valley that were, creating things basically because they wanted to make a lot of money. And it's a great article. If you Google it, Choose a Good Quest in Silicon Valley, it'll probably come up. But they talk about like, you got to think, do people really need another dating app or another like video social media app or this or that? Like, and I think like about Mark Zuckerberg and like at the end of the day maybe somebody else would have done it too, but has he chosen a good quest? I mean, look at what social media has done to the fabric of our lives and what it's done to our democracy. Like, yeah, like has he chosen a good quest? And I think part of it is whatever company or business you make, like you have a non-financial reason for being and say, I want to create a company that's going to make a positive dent in the universe. And, it's kind of like in Star Wars where the Death Star blows up that planet, and like the, Obi-Wan is like, the Force just, screamed and, that's the sound of, like a billion people dying or whatever, I want to have a company that if it went out of business that like would disrupt the Force. And then part of that is, being a giver and just doing the right thing and all that. But it's also telling the truth, and I think you heard that with my, my market prediction. And my entire book is telling the truth. Like when I give talks on it afterwards, and there'll be people like in the financial industry, like afterwards, they're like, oh my God, you are the first person we've ever heard speak at an investment conference that has ever like completely told the truth.
As sad as that is.
That's kind of our goal. That's our goal. But I think as you create your fund or your business or whatever, it's like, we probably only have one life, right? So go do something good and great. And if you do, the money will follow. But like, like Ryan said, you can smell when somebody's just chasing the money or, when somebody starts a business, it's like, just because I want to be rich. And there's this fascinating every single year since 1965, a sampling of entering college freshmen has been done where they ask them all these questions. And back like in the late 1960s, like one of the questions every year was, it talks about like, what are your top priorities? Like, for your life and like college and here on out. And one of the questions is, I want to create a meaningful philosophy of life. Okay. And like back in like 1967, 1968, like 74% of entering college freshmen said that was one of their top priorities. And they also asked, how important is it to be rich or financially successful? And back in 1967, 68, it was like, like 30% or something. Well, those have completely flipped. Like over time, you could just see them like the two just like, converge. And now like, and I forget the exact numbers that it was last year, but it's like 80% of entering college freshmen say that one of their top priorities is to be financially successful, and developing a meaningful philosophy of life is down to like 25%. And I think it's just a reflection of our society. I think social media makes it worse. And they always say, we're all comparing our insides to everybody else's outsides. And I think that happens. Like you look at these people that are on Instagram or TikTok or Snap or whatever, and you're like, oh, look, they're have all this, these houses and these trips and their lives look perfect. And I want that. So I have to have money. And none of that is true. None of it.
Wow. So would you say that is, it's kind of converging into a third helpful tip is some of these things you mentioned that are helpful to you. So you mentioned pitching a family office. Number one, you said the thing that impresses you is showing that the GPs have some stake in the game, or the founder, whatever it is. If it's a direct investment, a startup or a fund, whatever it is, show that you got some skin in the game. Number two, that you mentioned just now is show that you have a non-financial reason for existing. Yes, obviously you need profit. We know that, guys. Like if you pitch us, we know you need profit.
You look at Theranos, look at Elizabeth Holmes. Why was she able to raise all that money and have like George Schultz and Jim Mattis and all these, these people on her board and get the, Betsy DeVos and the Walton family and I think Larry Ellison invested and all these, it's because she told this amazing story. She said, as a child, I was always scared to get my blood drawn. And, I'd have to have all, maybe she was sick or something. But she's like, I hated it. And so, we're going to be able to run all these blood tests with just a pinprick. And she told the story of like, you're going to be able to go into Walgreens. You're going to get this entire array of tests. And imagine what this is going to do in emerging countries. It's going to completely change medical care in the developing world. Like this is such a compelling story that people just started throwing money at her, even though it was a fraud.
Yeah.
Like, and we can all learn from that, not to be a fraud, but the power of like, she's like, I am going to change the face of medical care and save millions or billions of people's lives by this new technology. And people are like, yes, let's back up a dump truck, take whatever money you want. Right. And I think we can all learn from that. And it's the power of stories. And especially if they're powers of stories of like, I want to make a dent in the universe. And like my dent is I want to spread truth and transparency surrounding the entire wealth management industry. And then I want to help my clients live more happy, fulfilled life in the face of wealth, because it's like, more wealth makes you happier, but also more wealth brings with it more challenges, more burdens, how to help people live like better, more fulfilled lives, even though they're rich.
Yeah. Reminds me of an old poet I used to listen to in high school, Biggie Smalls, right? More money, more problems, right? Wasn't that him?
Yeah, exactly.
And, and then what would you say, just to round out this thought on like the things you like to see when getting, when some of the deals that you did end up funding, how have you found, because the debate is out as far as people sharing their failures, hiding from them or being upfront with them. Yeah. How have you found, what does that mean if you've got a GP or a founder in front of you that said, look, I've got this amazing opportunity. I've done that. I'm going to change the world, right? They got all those things. They've got skin in the game. They've got a non-financial reason for existing. They're telling a compelling story, but then they're like, look, I haven't always got it right. I messed it up. I had, a couple good startups, couples that failed. Here's what I've learned, whatever that is. How do you find when people are open? Because you value honesty and transparency as much as I do.
We love it. And we ask, whether it's a direct investment or a fund or, even a public stock fund, we ask about their failures and, things that they got wrong. And some of the things were like, what were you most confident of that you got wrong. And we want to hear that. And we love it when, they're like, oh yeah, my 2013 vintage fund was a, fourth, was down in the fourth quartile. And here's why, and here's what we got wrong. And here's what we learned from it. It's just so important. In fact, I heard, I have this friend that, runs a single family office, but he also has a very successful, I think they're in fund 3 or 4, fintech fund. And he was on this podcast, and this podcast host asked this great question. He's like, what's your, tell me some mistakes. He's like, oh, you want to hear about the zeros? Here, let me tell you a few. And it was so fascinating, because usually you don't hear people come on podcasts, and he was telling this story. There's like some beverage, and like what he didn't realize is, they had this great beverage and this great price, but they didn't realize the games that need to be played to get to the part of the shelf where the consumer would see it. Like they were down like in the corner, right? And they're like, we just didn't know. We didn't know that the company needed to play this particular game to get like where you could see them. You just couldn't see them. So if you can't see them, you can't buy them. And that was one of the stories. It was just fascinating. But like, we want to hear that, because everybody, like if you've done this for long enough, you're going to have some failures, and, put them out there. And here's what I learned from them. I will tell you, like, if all you've had is failures, yeah, that's a problem. But, but don't hide from your failures. And, I'll tell you one thing that tips us off whenever we see, again, I'm talking about like public stock investment firms, like when they're just touting like their since inception number. And that's you can have a since inception and have that graph or whatever. That's totally fine. But if that's the only thing they're hanging their hat on, it gives us pause, because like an early manager, like if you're starting and, you're managing $10 million and you put up these huge returns, and then later you're managing $1 billion and your returns aren't as good, maybe your since inception looks really good because you were either lucky or, a different manager, or it was a different time period when you were killing it back when you were smaller. But if you look at how your investors have done, well, most of the money came in later. So if you're just looking at like a since inception, if you were there from day one, which almost nobody was. And again, it's not that you don't have that, but be honest, about your be honest about your returns. And, if you're coming in, don't just show, okay, I have 3 funds and I'm going to show the one that has a good track record. No, show all the funds, because we're going to ask, like, anybody that's any decent at due diligence, we're like, show us your other funds. It's like, oh, well, you just made it look like you had discovered alchemy. It's like, well, this was one fund. You have these other 2, and that's the game that's played in the mutual fund industry. They seed 5 funds and then they let them run for 3 years, and then they merge 3 into the other 2 at the end of 5 years. And we have all 5-star funds.
Wow.
So there's all these games that are played that we're like, you're just better off, even if you're not playing that game, you're better off just nipping in the bud saying, okay, we're going to be completely transparent. We have this investment manager. It's kind of interesting. He only invests in banks and thrifts. It's kind of interesting. But every time there's a really bad month, I get a call. In fact, I even say to him, like, Joe, you can stop calling me. Like, it's fine. You don't need to call me when there's a bad month. But I appreciate it, because he's like, we had a really bad month. And let me tell you, not just banks and thrifts were down, but we were down more than the KBW Bank and Thrift Index or whatever. And here's why, and here's what we learned. And I appreciate it. But on the other hand, like, you can stop calling me Joe. But like, I'm like, I trust this guy. Like, I'm going to put other people with him because if they want to invest in just banks and thrifts, but I trust him
because he's straight up.
He's straight up, yeah. And I don't know, like 50% of the fund is his money.
So he's got those elements, right? So you know what he stands for. He's got skin in the game, and he's very clear.
And he used to be a bank examiner. He worked for the Fed as a bank examiner. I mean, it's like his understanding of banks is like uncanny. And what he'll say, he's like, I have better analysis. Because I'll tell you, everybody else is covering banks, wasn't a bank examiner, and most of them are covering multiple industries. Like any other firm you go to, it's like, oh, I'm covering banks and this and this and this. And he's like, I only do banks. I only invest in banks, and I only, I know about it because I was a bank examiner, and then I worked at a big firm where I was the head analyst on financial institutions, and I've been doing it a long time. And you give me these younger analysts that are covering 4 different industries and have never gone and closed a failing bank as a regulator.
Man, I absolutely love it. This has been a phenomenal conversation, John. Enjoy mixing it up with you, brother. As always.
Yeah, me too. Thanks.
So just as we wrap things up, any closing remarks, any thoughts, any ways, if there's people out there who have 100 million or more under management, they want to contact you, ways to find your book. I mean, anything at all, anything at all.
Yeah. Yeah, just to leave behind, like if you're interested on more of us, me, or book or anything, my website is John, JOHN, as in Michael, Jennings.com, all one word, JohnMJennings.com. And you can find my blog there. It's called The Interesting Fact of the Day. I think my tomorrow is going to be on a set of research papers, and it's kind of known as egoism bias or responsibility bias. But one of the main studies is they took married couples and they asked them, like, what percentage of the housework do you do? Like, what percentage of the child care do you do? What percentage of like doing the dishes? And like the totals between the husband and wife were way beyond 100%, right? So each person was thinking that they do a lot more than the other person. It's because what you did. I unloaded the dishwasher today, so I'm feeling pretty good. But you don't realize that maybe your wife did it 3 times yesterday, or whatever. So it's pretty fascinating. So I write on just interesting things like that on my blog called the Interesting Fact of the Day. I always love new subscribers. Things like why do females have neater handwriting than males? Why do competitors like Lowe's and Home Depot or Walgreens or CVS? Why do they often have their stores together? So just interesting stuff.
Man, well, I love it, and I always like when you post them on LinkedIn as well, and I definitely follow and like a lot of the things you put there too. So just to summarize everything, folks, gain knowledge, especially on allocating. Read a lot of books, and the second thing is learn the right way to pitch a family office. John gave us a whole discourse on things that work and don't work. And finally, have skin in the game, a compelling reason for existing, and don't shy away from your failures. You do these things, and you too will be well on your way in your pursuit of making billions.
Wow, what a show. I hope you enjoyed this episode as much as I did. Now, if you haven't done so already, be sure to leave a comment and review on new ideas and guests you want me to bring on for future episodes. Plus, why don't you head over to YouTube and see extra takes while you get to know our guests even better. And make sure to come back for our next episode where we dive even deeper into the people, the process, and the perspectives of both investors and founders. Until then, my friends, stay hungry, focus on your goals, and keep grinding towards your dream of making billions.